What a great day it was for the Australian share market today, a rise of 1.5%, and most of the sectors trading higher, especially the materials, the financial, as well as the telecom space. There has been a lot of talk that some of this has been driven by the Bank of Japan's actions, which have driven 10-year Japanese government bonds to a record low, and yields on the 30-year government bonds to lows that we haven't seen in around about a decade. So let's talk to our panellists on the Bank of Japan's actions and what that means for the Australian share market. So David, just having a look at the Australian share market, are you positive or negative on it at the moment?
Pretty neutral, Julia. I mean, there's certainly some sectors that have some pretty exciting outlook. Bank of Japan is an interesting situation. What they're effectively doing is they're reducing the value of the yen, which is going to massively help their exports, particularly electronics, motor vehicles, etc. There is a bit of a view that if their domestic economy gets going, they may start importing a little bit more iron ore for steel production, etc. But I'm not a massive bull on Japan, primarily because the demographics are so appalling.
Yeah, the demographics, it just doesn't add up once you have a look at the mathematics of how they're going to repay their debt. So in the end, what are they hoping for with this experiment?
I think what they're really hoping for is to try and get a little bit of reflation, try and get the economy off the canvas. It's been on the canvas for obviously about 15 years. And I think most importantly is to try and get their export sectors really moving, and that includes electronics and high value manufacturing.
Let's go to our next caller. We've got Jim on the line from Perth. Jim, welcome. What's your question tonight?
Yes, good evening. My question is on Primer Biomet, PRR. Just wanted to get Les's opinion. The stock has been downtrending for the last probably 12 months. There's been a few changes in the company. Just wanted to know what his thoughts are and whether he still likes the company.
One of the problems, David, we've been seeing in that gold space is that while we have seen gold prices doing very well over the last 5 years, gold stocks haven't really kept up. And one of the problems that we see in this sector is that we've seen costs rising so much. So even though we have seen gold rising, we've seen costs growing at a larger percentage. In fact, in the last couple of years, I think it's been 10 to 15%. We're sort of seeing declining grades. I mean, if you wanted to invest in the gold space, do you have to be selective? What are some of the things you look
it's
out
like
for?
Everything, Julie. You've got to be extremely selective. I mean, the big problem with a stock like Newcrest is just this valuation. I think I was on the show 6 or 7 months ago when the share price was well over $30, and Montgomery had a valuation in the teens on it. And everyone, I think, would have probably laughed me off the show, but now we're heading there. It now looks a little bit more realistic, and it's really it's about production, it's about margin, it's about growth, it's about return on incremental equity. And if you're not getting an increasing return on incremental equity, then you're not a growing business and your intrinsic value isn't going north. And there's 2,000 stocks listed on the Australian Stock Exchange, and surely you can find 20 or 30 where the incremental return on equity is growing and the intrinsic value is growing. Unfortunately, in the case of a lot of gold miners, it's heading south, and you hit the nail on the head. It's heading south because the costs are going up. Production is having trouble rising because grades are going down, and it means that a greater amount of money needs to be spent on exploration as well as actually just getting this damn stuff out of the ground. And of course the high Australian dollar, is really
which is going higher.
At 104 cents, it is, an imposition on a lot of our miners.
Okay, let's go to our next caller. We've got Michelle on the line from Clovelly. Michelle, welcome. What's your question tonight for our panel?
Hi, hi everyone. I'm interested in Resmed, RMD, and if the panel has time, what if, WTF. I'm hoping if they like them, what they might suggest is a good entry price. Thank you.
Sure. I guess Resmed has been quite a defensive stock because people with sleeping problems, they have it whether the economy is good or whether it's bad. And the fact that, this sleeping test now that can be done at home has sort of boosted revenues as well. Do you see this continuing, or do you see competitors sort of starting to eat away?
No, we hold Resmed at Montgomery Investment Management, Julia, and we're very, very positive on it, Michelle. Look, in short, as Julia says, there's a few big macro dynamics going on. Firstly, with both obesity and demographics. Surprisingly or unsurprisingly, more and more people are in demand for Resmed products on a global basis. And the other thing is, with technology, what's going to happen over time is that there's going to be a lot more testing done at home rather than having to go into to specific surgeries to test your sleeping patterns. So we like Resmed. It is a superbly run business, and we think it has a very, very good medium-term outlook. Just quickly on what if, Michelle, what's interesting, although at Montgomery we're very, very keen in this sort of online space, what if is one that we're more cautious on, and the reason is that if you look at the room numbers that came out in their interim report, that's the half year to December 2012, they've actually been steady now for something like 7 half years in a row. So they're roughly doing about 3.5 million rooms per 6 months, which is about 1 room in 10 in the country. But as I say, that number has been very, very steady for 7 consecutive half years, and you don't want to be paying a massive multiple for something that's not getting volume growth. We like to find businesses that have got really, really good volume growth. So in the case of What If, that's one that we've moved out of, and we would prefer in the online space Seek.
Time to start the stock watch. So this time, David, what are you watching?
Thank you, Julia. We are watching Cash Converters. CCV is the ASX code. Peter Cummins is the CEO and has been there for 22 years. Earnings are growing very, very strongly from $30 million to $44 million to $57 million. Return on equity is over 20 percentage points. Current price is $1.35. We value it at $1.65 with good dividends. That should give you a 20% return over the short to medium term.
Welcome back to the program. If you've just joined us, David's stock watch was CCV Cash Converters. And looking at Cash Converters, I mean, it's had a positive performance in 2013 so far. A beautiful looking chart there. The stock's up 13% in 2013. And I guess when we look at Cash Converters, we often look at sort of that retailing space, but it's a lot more than that. It's almost like a mini financial institution, if you like.
Yeah, microfinancing, I think, Julia. So effectively they've got 710 stores globally. In fact, they're spread across about 18 different countries. They have very good market share in Australia and the United Kingdom, but they still have a lot of growth up their sleeve in the UK. And effectively they sell second-hand goods across these 710 stores. Many of them are company owned, some of them are franchised. In fact, they're buying some of the stronger franchise stores back. They have revenue line maybe approaching $300 million a year. Their market capitalisation is about $580 million. They have virtually no debt. I think at June 30, 2013, we're expecting net indebtedness to be just $5 million, which would be a sort of a net debt to equity of 4 percentage points or something, so a superb balance sheet. At Montgomery, as you probably know, we go from an A1 down to a C5 rating. In Cash Converters case, it's an A2 rating, so it's the second highest of our 15 cell rating system. As I said, return on equity is over 20 percentage points, and we see the net earnings growing from maybe $30 million to sort of $40 million to $55 million over the next 2 or 3 years.
Wow.
Peter Cummins, who's the CEO, has been there for 22 years, and we think he's done an absolutely superb job.